Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Thursday, March 12, 2026. And this wasn't a casual dip. Oil ripped back to the $100 handle, and the tape answered with broad selling. Semis and high beta tech cracked first, then the weakness spread. Energy and a few defensives were pretty much the only things still standing. On the S&P 500 heat map, it's a sea of red, almost the entire board. And here's the key detail. There's no mega-cap mask. Apple, NVIDIA, Microsoft, Amazon, Google, Meta, Tesla, all red. The darkest pockets are semiconductors and consumer discretionary. Meanwhile, energy is where the green actually pops. So what's the money flow behind that heat map? Capital rotated out of long-duration, high-beta growth, AI, semis, discretionary, and into two places. First, energy as the inflation and war hedge. Second, defensives like staples and utilities for cash flow certainty. Small caps underperformed too. Same message, less tolerance for balance sheet risk. Here's the context that ties it all together. Crude is forcing itself back into the equity conversation. Once oil reclaimed $100, the read-through in this tape was immediate. Higher inflation risk, less room for the Fed to ease, and less appetite to pay up for far-out growth. This wasn't selective profit-taking, it was broad risk reduction with the generals participating. Tone into next week? Defensive, suspicious, fewer dip buys? Quick chatter check. In the material we have today, there aren't specific, verifiable desk rumors or clear market chat bullets laid out. The backdrop everyone's talking about is geopolitical and oil-driven, but any extra headlines, beyond the confirmed market moves, should be treated as unverified until they're sourced. So, price action first, narratives second. Yesterday, the world pulled the ultimate emergency cord with the largest oil release in history. About 400 million barrels meant to flood the market and kill the price spike. So why did crude just explode back above $100 a barrel today? And here's the more chilling question, is the US government officially choosing total war over your wallet? It's March 12, 2026, and the so-called 400 million barrels saved just hit a brick wall. Here's the cold math. The IEA release covers around 20 days of supply, but the Strait of Hormuz carries about 20 million barrels every single day. You can't flood a market that has a total heart blockage. Oil is defying gravity because the blockade isn't a glitch, it's the strategy. Iran's new leader, Mojtaba Khamenei, just broke his silence with a formal decree to weaponize the strait indefinitely. He's not looking for a deal, he's looking for a stranglehold, and the war is leaking. Iranian drones just torched fuel storage in Bahrain, sending black smoke over the international airport. At the same time, we've confirmed a USK C-135 refueling tanker went down in western Iraq, a major hit to the logistical backbone of the air campaign. Even President Trump has shifted the script. On Truth Social today, he shrugged off the 360 national gas average, saying, "When oil goes up, we make money," and signaling that stopping the so-called evil empire is now a higher priority than the price at the pump. The safety net is gone, and the peace dividend is officially over. We're tracking every move of this energy war, and what it means for your portfolio. Stay locked to Cat Eye US markets. Gas just hit $3.60, a level that historically lines up with a retail recession. Is your favorite stock in the line of fire? And with airlines losing about 5% in a single morning, is this a buy-the-dip chance? Or the start of a full-on sector meltdown? It's March 12th, and the energy tax is officially here. We're not just talking about your commute, we're talking about a major squeeze on the American wallet. The fuel guzzlers are bleeding out. American Airlines and Southwest are taking the heaviest hits because at $100 oil, their profit margins are basically vanishing into the jet stream. But the pain runs wider. When gas jumps 35 cents in a week, families stop browsing and start budgeting. Watch Nike, Target, Walmart. Those tickers are already feeling the chill as discretionary cash gets diverted into the gas tank. And with diesel at $4.60, small truckers are in a cash flow death spiral. The safety net is gone. Are you rotating to safety or just waiting for the crash? Subscribe to Cat Eye US Markets to stay ahead of the squeeze. Exxon, ticker EXOM, was a clean tell today. It finished green while the broader tape was red. The move fit the dominant read of the session. Energy as the hedge when crude's around $100 and macro stress is rising. And when Exxon is acting like a shelter, that's not stock picking, that's positioning. Chevron, ticker CVX, was the other big green island. On a day like this, when CVX is leading, the tape is saying macro stress, not company-specific surprise. It matched the sector story perfectly. Energy leadership as crude surged. NVIDIA mattered because it's the AI Fulcrum, and it was red with the rest of the complex. That reinforced the idea that this wasn't acute rotation inside tech, this was traders derating growth exposure in a risk-off tape. Intel, ticker INTC, stood out for the wrong reason. It was an outsized laggard inside a semiconductor group that was already getting hit. And that's why it mattered. The market punished the lower confidence chip exposure most aggressively. Tesla, ticker TSLA, acted like a sentiment lever today. It underperformed as high beta discretionary got de-risked, and the read was straightforward in this tape. Traders were cutting beta, not just shuffling positions. GE was another notable tell. It broke hard, and the analysis flags stock-specific pressure on top of a risk-off market. But in terms of market tone, a big industrial bellwether sliding that much darkens the cyclical picture. Looking ahead, the calendar is the catalyst. Monday, March 16th, Empire State Manufacturing. Tuesday, pending home sales. Wednesday, March 18th, the Fed rate decision, statement, projections, and the press conference. Then Thursday, jobless claims, Philly Fed, and new home sales. In this kind of tape, traders will be watching whether oil stabilizes and whether the megacaps can find their footing going into FOMC weak positioning. Bottom line, today was about protection, not opportunity. Oil at $100 pulled leadership into energy and pushed investors toward defensives. And with semis and high beta taking the first hit, the next tell is simple. Do sellers keep pressing, or do the generals stabilize? We'll be watching oil breadth and the Fed week setup. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.